There's a particular kind of silence that should worry you more than noise ever could. And it is settled this year over a warehouse district in New Jersey that most Americans could not find on a map, but whose vaults may end up mattering more to their savings than anything said this week in Washington. Somewhere in the trading week just passed, silver changed hands in New York at a little under $60 an ounce, down sharply from the extraordinary intraday peak above $120 it touched earlier this year, a peak that startled even the analysts paid to expect surprises. Gold, its older and more sober cousin, sits above $4,100, having flirted with $5,500 not many months before. These are not modest numbers. They are the kind of numbers that, in a properly attentive republic, would dominate the evening broadcasts. They do not. And the gap between what is happening and what is being discussed is itself the subject worth your attention. Politics, Aristotle observed, is downstream of what a people believe about scarcity and abundance. It has taken modernity some time to relearn what antiquity understood instinctively, that the movement of hard metal in and out of vaults is never merely a commodity story. It is a story about trust, and trust, once it begins to erode, erodes the way a coastline does, imperceptibly, then all at once. Something has been moving in the vaults of the COMEX, the exchange where most of the world's paper claims on silver are written and settled, and what has been moving is not the ordinary tide of commerce. Deliveries of physical metal have run at a pace the exchange's own historical record does not contain a precedent for. Millions of ounces claimed in single trading sessions, month after month, through a stretch of more than a year in which the pattern never meaningfully broke. A market that spent generations content to trade promises about silver has begun, in significant and organized fashion, to demand the silver itself. This distinction between a promise and the thing promised is the oldest distinction in finance, and also the one modernity is most tempted to forget. A futures contract is a sheet of paper, or these days a digital ledger entry, obligating one party to deliver a fixed quantity of metal to another at a fixed date. For most of the exchange's history, the overwhelming majority of contract holders never asked for the metal at all. They closed their positions in cash and went home. That habit allowed the volume of paper claims outstanding to grow far beyond the physical metal actually sitting in registered vaults, a gap that functions admirably right up until a meaningful share of the paper holders decide in the same season that they would prefer the metal. Analysts tracking the exchange describe the ratio of paper claims to deliverable ounces as elevated well beyond historical norms, even as the market has shown spells of backwardation, spot silver trading above the futures price, a condition that shows up historically when buyers want the metal now more than they want a promise about later. A structure can carry a great deal of stress before it visibly cracks. The engineers who study such things will tell you that the crack, when it finally shows, is rarely the beginning of the story. It is closer to the end of the first chapter. Consider, too, who has been doing the demanding. This is not simply a swarm of anxious retail investors clearing out coin shops, though there has been some of that. Institutions with names and balance sheets and fiduciary obligations have been raising capital in scale for the specific purpose of acquiring and holding physical metal rather than paper claims on it. Moves that, in the normal course of finance, unfold over years of quiet accumulation rather than sudden, publicly announced urgency. When an institution of serious size behaves as though the ordinary rules of patience no longer apply, the sensible response is not panic. It is attention. Markets send few messages this legible, this rarely, and they tend not to repeat themselves for the benefit of latecomers, none of which would matter terribly much if it were an isolated American phenomenon, a curiosity confined to one exchange in one country. It is not. And here the story widens considerably into territory that touches not merely on portfolios, but on the architecture of global power, which is, when you strip away the jargon, what a monetary system ultimately is. If you have read this far, you are the sort of person this channel exists for, someone willing to sit with a complicated argument rather than skim past it. And if that describes you, do the 5-second thing and subscribe. Because the next installments in this story are the ones that connect the vault numbers to a deliberate, years-long geopolitical repositioning that almost no one in the mainstream financial press has been willing to name plainly. Don't leave it to an algorithm to decide whether you see them. See. Because the thread, once you start pulling it, does not end in New Jersey. It runs, as so many of the most consequential threads in modern finance now run, through Beijing. At the start of this year, China moved silver, quietly, procedurally, in the dry language of trade regulation rather than diplomatic declaration, into the same strategic category it is already assigned to rare earths, tungsten, and antimony, a material too important to the next economy to be allowed to flow freely across borders. Exports now require government licensing, restricted to a limited roster of approved firms meeting substantial thresholds of scale and creditworthiness. China had been, for years, a significant net exporter of refined silver, moving thousands of tons annually into world markets. That flow has been sharply curtailed. Elon Musk, on hearing of the restriction, offered the terse public judgment that it was not good, and that silver is needed in many industrial processes. A technically accurate statement that rather understates the situation the way describing a dam as somewhat obstructive to water would understate a flood. This is not China's first such maneuver, and that is precisely the point. A nation that has spent years accumulating gold at a pace analysts increasingly suspect exceeds its own official disclosures, that has built out settlement infrastructure explicitly designed to move physical metal without touching Western financial plumbing, does not reclassify a second strategic metal by accident. Nations position raw materials the way chess players position pawns, individually unremarkable, collectively decisive. Silver, unlike gold, carries the added complication of being genuinely indispensable to industry. Solar panels, electric vehicle components, and the vast silver-hungry build-out of artificial intelligence infrastructure and data centers now underway across the developed world all compete for the same shrinking pool of refined metal. The United States, for its part, has placed silver on its own list of critical minerals, citing its role in energy and defense manufacturing. Two of the largest economies on Earth have now, within months of each other, formally declared the metal strategic. Markets, which are considerably better at pricing yesterday's news than tomorrow's, have not finished digesting what that means. Layer onto this a supply side that behaves nothing like the market for iPhones or soybeans. Most of the world's silver does not come from silver mines at all. It arrives as a byproduct of mining gold, copper, lead, and zinc, which means producers cannot simply respond to a higher silver price by digging more of it. The geology does not consult the price chart. Global mine output has been essentially flat for over a decade, even as industrial demand, driven overwhelmingly now by the green energy transition, has climbed. The result, by most industry estimates, has been a run of consecutive annual supply deficits stretching back across the first half of this decade, shortfalls that were, for years, quietly absorbed by drawing down existing above-ground stockpiles. Stockpiles, however, are not infinite, and a nation that was helping refill them from the export side has just throttled that flow to a trickle. There is a discipline to reading history correctly, and it consists mostly of resisting the temptation to read it backward, to assume that because a thing eventually became obvious, it must always have announced itself loudly. It rarely does. The people who noticed the early tremors of the great monetary shifts of the last century were, almost without exception, dismissed in real time as alarmists, gold bugs, cranks with a hobby horse. The consensus caught up with them only after the fact, at which point their foresight was relabeled as obviousness, because hindsight is a great flatterer of the wrong people. We are, on the available evidence, sitting inside one of those stretches of premature clarity again, and the discomfort of that position is precisely what makes it worth sitting in. Widen the lens further, and the precious metals complex is not moving in isolation. It is moving inside a global economic weather system with several fronts converging at once. Conflict disrupting energy flows through the Middle East has pushed oil prices higher and complicated the inflation picture at exactly the moment central banks hoped that picture might simplify. In the United States, inflation readings this year have run comfortably above the Federal Reserve's target, even as growth has shown signs of softening. The textbook definition of the stagflationary bind that confounds monetary policy because the standard remedy for one half of the problem worsens the other. Cut rates to support a slowing economy, and inflation gets more oxygen. Hold rates to fight inflation, and the slowdown risks becoming something worse. There is no clean door out of that room, only the management of two competing discomforts, and precious metals have historically been among the few assets that do not require the room to be fixed in order to perform well. They simply require the room to remain uncomfortable. Central banks around the world reached this conclusion well before most retail investors did, and they have not been shy about acting on it. Turkey leans on gold to stabilize a volatile currency. Russia holds it as an asset that sanctions cannot freeze. India and a cluster of Middle Eastern economies have been accumulating it as long-horizon diversification away from a dollar-denominated system, whose durability they have started quietly to question. This is not sentiment. It is the kind of decision institutions make only after years of internal deliberation, and it has been accompanied by a genuine surge in Chinese demand for gold-backed investment vehicles. The gold-silver ratio, the ancient measure of how many ounces of silver it takes to buy 1 ounce of gold, currently sits in the high 60s to 70. A considerable distance above the ratios of roughly 15 to 20 that prevailed across the centuries when both metals functioned as actual monetary instruments rather than mere commodities. Whether or how quickly that ratio compresses toward its historical range is not something anyone can honestly promise you. But the size of the gap is not in dispute, and gaps of that size have a way of eventually narrowing one direction or another. Wall Street's own institutions, for what their forecasts are worth, have been revising price targets upward through the year as these pressures have intensified, with several major banks now projecting further gains in both metals before year's end. Though it is worth saying plainly that forecasts of this kind are educated guesses dressed in the clothing of certainty, and the metals markets have humbled confident forecasters before and will again. What is harder to dismiss is the behavior, rather than the predictions. The vast majority of ordinary investors have not repositioned any meaningful share of their savings toward physical metal. The dominant financial conversation remains fixated on interest rate speculation and equity indices. Even mining companies, firms that dig the metal out of the ground for a living, still convert nearly all their revenue into ordinary paper currency rather than retaining any of what they produce. An irony that, should it ever correct itself, would add its own layer of demand to an already strained physical market. The institutional rotation, in other words, is still in its early innings. The retail public has barely noticed the game is being played. And the pace of the vault withdrawals, according to those who study them closely, is not chaotic. It has the texture of discipline, metal leaving in a manner organized enough to avoid triggering the very price spike that a disorderly rush would produce, as though whoever is accumulating would prefer the world stay calm a while longer. Read that sentence twice. An accumulation deliberate enough to disguise its own urgency is, by its nature, not something that announces itself with a press conference. It announces itself the way it has for centuries, in the ledgers, the delivery notices, the vault records that sit open to anyone patient enough to actually read them, rather than simply glance at the daily price and move on. So here's where the argument leaves you, and where every honest argument about markets eventually must, with a question rather than a certainty. Does the paper-silver market survive a physical drain of this character and duration? Or are we watching, in the unglamorous language of delivery notices and export licenses, the early paragraphs of a repricing that historians will eventually treat as a hinge point, the kind that, like most hinge points, felt unremarkable to the people living through it? Tell me what you think in the comments, genuinely. Not as a courtesy, but because this is one of those subjects where the collective judgment of a wide, skeptical audience is worth more than any single narrator's certainty, mine included. The signals here are not unanimous because markets never offer unanimity, and they are not certain because markets never offer certainty either, but they are coherent, consistent across geopolitics and market structure and historical precedent alike, in a way that deserves more than the silence it has so far received. And remember, this is for education and discussion only, not personal financial advice. I'm sharing a way to think through the history, the market, and the ownership questions so you can make your own decisions with your own money and your own risk.